Welcome to the Explainer. Today, we're doing something really exciting. We are putting a high-flying AI darling through the absolute ultimate stress test. We're looking at Innodata, ticker symbol INOD. Now, this is a company operating right at the bleeding edge of the artificial intelligence boom, providing the critical data engineering that actually trains frontier AI models. But listen, in a market that's completely fueled by AI hype, we really have to ask, is the stock actually worth its price tag? We're going to find out by running Innodata through the cold, hard math of some legendary investing frameworks. All right, let's dive right in. Here is our rigid, step-by-step analytical gauntlet for today. We'll start with a quick snapshot of Innodata, view it through the incredibly strict lenses of Warren Buffett and Benjamin Graham, shift gears to the Peter Lynch framework, build out a discounted cash flow valuation, check some alternative models, and finally deliver our final synthesis and verdict. Okay, Section 1, Company Snapshot. Let's set the stage and see what this business actually looks like. So Innodata is currently trading around $95.50 with a price-to-earnings ratio of 37.7. They're a global data engineering and AI systems services company. To put it simply, if you're a massive tech giant building a frontier AI model, you desperately need high-quality, perfectly structured data to train it, evaluate it, and make sure it actually operates safely. That is exactly the picks and shovels infrastructure role that Innodata plays. Now, what's really interesting here is the sheer velocity of their growth. It's honestly staggering. In Q1 2025, they did $58.3 million in revenue. In Q1 2026, $90.1 million. That is a massive 54% year-over-year increase. And get this, management just raised their forward guidance, projecting roughly 40% or more growth for the full year of 2026. So this isn't just some fluffy story stock. They're converting the AI boom into actual, explosive top-line growth. Moving right along to Section 2, the Buffett and Graham lenses. How does a high-growth AI stock hold up against the most conservative value frameworks in history? This is the ultimate question, right? If we sat Warren Buffett and his mentor, Benjamin Graham, down in a room and just handed them Innodata's financials at $95.50 a share, what would they actually do? Would they buy the phenomenal growth, or would they just run away from the premium price tag? Well, let's run through Buffett's famous checklist. Economic moat? Pass. They're building proprietary datasets with retained IP rights, which creates massive switching costs for their big tech clients. Consistent earnings? Pass again. They posted $14.9 million in net income in Q1 alone. High return on equity? Pass, sitting very nicely above 22%. Manageable debt? Oh, absolutely a pass. They have a microscopic debt-to-equity ratio of roughly 0.03 and a fully undrawn $50 million credit line. But then we hit the margin of safety. At a 37.7 PE ratio, this is where Buffett's pen stops. The fundamentals are shockingly strong, but the price just doesn't offer that deep margin of safety he demands. But here's a crucial point we can't ignore. They actually generate real cash. Buffett loves what he calls owner earnings. If you take Innodata's Q1 net income of $14.9 million, add back the $2.2 million in depreciation and amortization, and then subtract the $2.4 million in capital expenditures, you get an impressive $14.7 million in owner earnings for just one single quarter. That proves Innodata generates serious, tangible cash. It's not just hype. Okay, but let's get even more rigid. Benjamin Graham is the literal father of deep value investing. He relies on a very strict formula to calculate a stock's baseline defensive value. You take the square root of 22.5, multiply it by earnings per share, and multiply that by book value per share. Graham wants to buy hard assets, and he wants them cheap. So when we plug Innodata's numbers into Graham's formula using an annualized EPS of $1.68 based on their Q1 performance and a book value per share of roughly $3.93, we get a Graham intrinsic value of exactly $12.18. Contrast that with the current market price of $95.50. It is trading at a massive premium to its book value. Under this strict asset-based framework, Benjamin Graham would probably run for the hills. All right, Section 3, the Peter Lynch lens. Let's shift gears from deep value to growth at a reasonable price. You know, Peter Lynch loves to categorize companies, and Innodata fits perfectly into his absolute favorite bucket, the fast grower. He looked for small, aggressive enterprises growing at 20 to 25% a year. Given that Innodata just posted 54% growth and reaffirmed 40% plus forward guidance, it easily clears this hurdle. This is the exact profile of what Lynch calls a potential multi-bagger. The core metric for a Lynch investor is the PEG ratio, price to earnings divided by growth. Let's do the math real quick. We take their PE ratio of 37.7 and divide it by their projected growth rate of 40%. That gives us a PEG ratio of 0.94. For a Peter Lynch investor, finding a PEG ratio under 1.0 is literally the holy grail. It means you're paying less than 1 unit of price for every unit of growth. But we have to look at the whole picture, and Lynch heavily scrutinized insider activity. We've got a potential red flag here. In May 2026, CEO Jack Abuhoff sold 250,000 shares for about $23.7 million, and a couple of directors sold as well. However, we have to balance this against a massive green flag. Abuhoff still holds over 1.34 million shares. So yeah, some profits were taken after a huge run-up, but this CEO still has incredible skin in the game. He is heavily tied to Innodata's future. Section 4. Discounted cash flow valuation. Time to do the mathematical heavy lifting and project out those future cash flows. To build our base case, we have to make some logical assumptions. In Q1, Innodata generated a whopping $37.3 million in operating cash flow. Subtracting $2.4 million in CapEx gives us almost $35 million in free cash flow for just 1 quarter. If we aggressively extrapolate that baseline, we get an annualized free cash flow of around $139 million. We're going to use management's 40% projected growth rate for years 1 through 5, a conservative 3% terminal growth rate, and an 11% discount rate, which is pretty standard for a high beta tech stock like this. And this brilliantly illustrates exactly what happens when we run those numbers through a sensitivity matrix. You can see how the value shifts based on slight tweaks. Under our realistic baseline assumption of an 11% discount rate and 3% terminal growth, Innodata's fair value sits right at $131 per share. Honestly, even if we get more conservative and use a 12% discount rate, the intrinsic value still sits comfortably between $102 and $119. Section 5. Alternative Valuation Models. Let's check our work by bringing in Wall Street sentiment and a few comparable multiples. Wall Street is definitely leaning hard into the AI narrative here. Recent analyst reports show BWS Financial raising its price target on Innodata to $140, citing their shift to becoming a critical AI data quality partner. Wedbush also lifted its target to $120, highlighting their essential role in training AI models. What's absolutely fascinating is how well Wall Street's qualitative, narrative-driven targets align with our strict quantitative DCF calculations. Let's throw 2 more alternative models at it. If we apply a comparable PE expansion, assuming a 45x multiple on forward earnings, which, by the way, is very typical for high-growth SaaS and AI infrastructure, we get an implied fair value range of $115 to $130. Then there's the reverse DCF. If we take the current price of $95 and work backward, the market is pricing in only about 28% future growth, meaning the current market price is actually underpricing management's explicit 40% growth guidance. Section 6. Final synthesis and verdict. We've run the gauntlet. Now it's time to bring all of our interrogators together. Here is the final synthesis. Benjamin Graham would look at that $12.18 asset value and issue a hard sell, no question. Warren Buffett would love the moat and the cash generation, but at this price, he'd issue a hold and wait for a margin of safety closer to $50 or $60. But for Peter Lynch, that PEG ratio signals a clear buy. Our base case DCF points to a 131 fair value, which is a buy, and Wall Street consensus agrees with a buy in the 120 to 140 range. The strict defensive value investors would run away, for sure, but the growth metrics strongly support the current valuation. Blending all these insights together, Innodata passes the gauntlet with flying colors when it comes to growth, operating leverage, and massive cash flow generation. Their balance sheet is pristine, with virtually 0 debt. However, the risks are real, folks. They have heavy client concentration, with one big tech customer expected to drive $51 million this year, and that absolute PE multiple is undeniably rich. So, the final verdict? It's a buy for growth-oriented investors, but a definitive sell for strict asset-based value investors. I want to leave you with one final provocative thought. Management just announced they were selected as a global trust and safety partner for evaluating AI models by a massive hyperscaler, a market they estimate has a potential annual run rate of $3 billion. If Innodata is truly cementing itself as the foundational picks and shovels data provider for the entire future of enterprise AI, is a 37 PE ratio not just reasonable but actually a total bargain? That's the question you need to answer before you decide to invest. Thanks for joining me on this explainer, and I highly encourage you to dive deeper into the data yourself.